Hello, today we're here with Al Nelson from Crosscountry Mortgage. He has an office in Saint Croix Falls. He has been helping uh, buyers and people with refinances with real estate for 18 years now. He's a great local lender. I have worked with him many times. Al, so could you kind of go over the types of loans for mortgages?
Yeah, there's four different types of loans that we do when it comes to purchasing and or refinancing. Your traditional loan is it's called a conventional loan, Freddie Mac, Fannie Mae. You need 3 to 20% down plus to do a conventional loan. You'll have mortgage insurance if you don't put down 20%. The more you put down, 5, 10, 15, the lower the mortgage insurance goes. Then there's probably the next most popular loan we do is an FHA loan. That is a government loan. FHA, you need 3.5% down. You can do more. Also comes with mortgage insurance because you're not putting down a 20% down payment. FHA is a little more forgiving for credit score, higher debt to income ratios, and things like that. But you only need 3.5% down. The next two loans, the USDA and VA. VA, you need to be a veteran. It's no money down. The beauty of the VA loan is there is no monthly mortgage insurance. You don't have a mortgage insurance payment. So we like to do VA when we can if there's low or no down payment. And then another popular loan we do is the USDA rural housing. That loan is no money down. It does have income limits, meaning you can only make so much money depending on which county you are purchasing in. But that's a very popular loan. The mortgage insurance is very low on that. You need a little bit better credit score, typically in the mid 600s and up to be able to do the USDA loan. They're very limited on debt to income ratios also. But that's a great loan. It's lower mortgage insurance than the FHA loan. So those are the four different loans that we typically do.
So how does credit and credit scores play into a factor when someone is applying for a mortgage?
So we always, one of the first things we do when we take a loan application is I pick people's brains about credit. Credit scores are driven by your payment history in the past 10 years. It goes back 10 years and it looks at your payment history. It's one of the only ways that creditors can tell if you're a good risk or a bad risk when it comes to borrowing you money to purchase a home. If you've had a good payment history, you will typically have a good credit score unless you've maxed out credit cards that can drive down your score. But we can look at that, and sometimes recommend to people to pay down a credit card. Maybe you have a $500 credit limit and you owe $505 on it. That's really going to drive your score down because you're over the credit limit. If you paid that down to $100 or under, you're under 20% of your credit limit, and that would pop your score up within 30 days a lot. So yeah, and when it comes to credit cards, they're typically one of the best things for your credit, also one of the worst things. So a little oxymoron there, but credit cards are really good for credit. They help drive your credit up better than an installment loan. Credit cards would be revolving debt. Installment loans would be a car loan. It's good for your credit, but if you only had a couple of car loans on your credit, it wouldn't, you may not even have a score in the 700s. If you had two credit cards that you've had for 2 or 3 years that you've been making good steady payments on, no late payments, that would probably give you a credit score in the mid 700s.
So is it better to use your credit card a little bit, have some balance on there, or to have them paid off completely?
Yeah, it's okay if you pay them off. It's best to have a little bit of balance on there. What we don't know and you don't know is when is the creditor report, what day does the creditor report to the credit bureaus? They report one day.
Sure.
There's 3 bureaus. There's Equifax, Experian, and TransUnion. they all have a different method of scoring. They're all getting the same credit history, but they have different scores.
Sure.
It's best to owe a little bit on your credit card, but keep that limit under 50% or even down under 20 or 10% if you can.
That makes sense.
Yep.
So a lot of people ask or wonder about down payments for homes. Do you need a big down payment to purchase a home?
You do not. That's probably the biggest myth out there in our industry is people wait. I'll be talking to people and they'll say, yeah, I just need to save some more money. I'll be ready to buy in a year. Well, right now, interest rates are so low. It's a great time to purchase. Your dollar's going to go a lot further right now with interest rates being historically low. So no, you do not need a big down payment. Like I said, we have a couple of no down. One of them, you have to be a veteran, which a lot of us aren't. But then the other one is the USDA rural housing. We do a ton of those. If you don't qualify for that loan, because it is a little bit tighter loan to qualify for, then we have the FHA with 3.5% down. There's a conventional loan, Freddie Mac, Fannie Mae conventional, that has a 3% down. That also has some income limits to it. But so you don't need a lot of money down. You know, your average home price around here, you probably need about $5,000-6,000 at the most to be able to, or less if you're buying a $100,000 home, you could get into $3,000.
Right.
Yep. Yeah.
Excuse me. So, what are the things not to do when applying for a mortgage, or let's say you've been pre-approved for a mortgage and you're working through a transaction, you've got an approved offer and all that stuff? What shouldn't you do?
So a simple one is don't go out and charge up your credit cards. Once we've got a picture of you, lenders always have to look at credit again right before closing. So just because your credit is good enough and you're approved today, pre-approved today, you go out and find a house, we start working on your loan. Sometimes takes 2 to 3 months from application to closing. It doesn't have to take that long. It may take 3 weeks if you find a house right away. But in that window of time, you could charge up your credit cards, make a late payment, open up new debt. I had somebody recently hit a deer with their car. They had to go replace their car, needed to get a loan. So they called me ahead of time. I recommend people do that. Sometimes, he had to get to work, so he had to go get a car. We looked over his credit. I told him what he could approve to still fit in his debt to income ratio so he could close on his house. So sometimes you have to do that, but it's best not to do any new credit pulls at all.
Gotcha. So don't add any more debt.
Correct. One of the things people get fooled on sometimes is they'll see an ad that they can go buy furniture with no payment for 12 months.
Right.
Or appliances, and they'll go do that ahead of time before we close. What they don't realize is they are applying for credit. Now you have a new credit pull. We're going to find out about that. And when they do that, there is no payment for 12 months. That makes it really difficult because now you have new debt. We have to prove what your payment's going to be. And that gives us and the borrower a huge headache right before closing.
Right. Yeah. That makes sense. Yep. Back to rates quick. What are the mortgage rates right now?
Today, February 13th, 2021, your average 30-year fixed rate today is probably 2.75.
Nice.
They're really good. Rates really driven on what's your credit score, what type of loan are we doing, how much money are you putting down.
Yep.
If we're doing a refinance, they're driven on how much equity do you have in your home, what is your credit score again.
A lot of variables.
Probably your average rate today that I'm locked just about every day is that 2.75 range on a 30-year fix. You do a 20 and 30 years are very similar, usually about the same. You get down to a 15-year, 10 and 15-year rates are usually at least a half a point lower, if not a little more than that.
Gotcha.
They're in the low twos. So
cool. Well, thank you. So last little follow-up here. Is there a benefit to choosing a local lender?
That's a funny, not a funny question, an interesting question, which I could almost turn right back to you because you've dealt with the, I don't want to mention names, but you see these big
The
companies.
large lenders that
Yeah,
advertise during the Super Bowl.
Quicken Loans, Rocket Mortgage,
Yeah.
They are the same company. They will send out a pre-approval letter before they pull credit, before they verify your income. They'll just pre-approve you. If you read the pre-approval letter, which I have many times, they're very generic and have a lot of disclaimers in them. They're just saying, yeah, you're pre-approved, but you don't see the small print in it, but you need to verify your income, to all of that.
Yeah.
Yeah, I think there's probably one of the biggest reasons to use a local lender, other than even maybe somebody out of the Twin Cities. I've been doing this again for 18 years. I have local appraisers. I don't get to pick where your appraiser goes, but I have a pool, who gets your appraisal, but I have a pool of appraisers that when I order an appraisal, that appraiser gets assigned to one of the appraisers in my pool that I've been working with for years. They're local. They know this market as well as the real estate industry. And that's probably something people don't even think of, but is one of the biggest benefits of using a local lender, whether it's me or somebody else local. Yes.
Right, because nobody has any control over who that appraiser is going to be.
Correct.
But if your pool is a local appraisers, they really know the market that much better. That's what we're saying.
Yeah, you might have a Twin City lender, and I used to work down there. I still do mortgages in the Twin Cities. I'm licensed in both states, but their pool might be Minnesota appraisers come over here, and they just don't always know the market as well as a local appraiser would. And so you can run into headaches. I've had many times where a Minnesota lender couldn't get a deal done over here for one reason or another, and it gets sent to me and we get it done. I'm like, oh yeah, that's their excuse for not getting it done. I mean, that's a true reason, but for us, it's not a big deal.
Sure. I know for me, when I tell buyers, I recommend a few local lenders for them. And I primarily do it because I know you're going to pick up your phone.
Yep.
And I've had experiences with some of the larger lenders that when we call and we have a question, I've talked to 5 different people and I really don't know who is in charge of that loan. It's just they're moving me around to 5 different people to figure out an answer, and I'm like, it get frustrating for the buyers and myself and the sellers on the other side. So
yeah, I get that. Yep, I answer my phone from 7 in the morning till 8, 9 o'clock in the evening. I would say if I'm having dinner or something with my wife, I'm not going to answer the phone. Leave a message. I will call you back. So you'll never interrupt me. I won't call you that late. No, call me. You work during the day. I need you to work, or you're not going to be able to afford to get this loan. So, it's okay to call me in the evening. I get it. You work during the day. Don't worry about calling me in the evening.
Right.
Or weekends.
All right. We will wrap up